Bell is now down more than 15% since 1 year, and with their more recent earnings report that were catastrophic, the least we can say is that it has made someone pretty mad.
I'm furious. This is a garbage decision by a corporation that should know better.
But now the real question on your side is to know whether or not it is a great time right now to buy the BCE stock. Well, this is going to be the question that I'll be answering in this video, where I'll make a full stock analysis on the Bell stock company. As always, I'll start by breaking down what is their business model, so how are they able to generate their income, and after I'll make a quick fundamental analysis followed by a price prediction to be able to determine what is the true value of this business. Without further ado, let's get to it right now. Bell Canada is one of the 3 largest telecommunication companies in the country, with Rogers and Telus with a market cap that is over $40 billion. It is well known by many Canadians to offer a wide range of different products and services in the telecom market. For example, great cell phones, internet, and television services. But what most people don't know is that they also have a bunch of different other subsidiaries. For example, they have the streaming services Crave, the electronic retail chains The Source, the broadcasting service CTV, as well as the popular group Bell Medias that has multiple TV channels such as V, Nouveau, TSN, and RDS. And so all of these products and services that they are selling have helped them to generate over $24 billion in 2023. If we go more in detail, we can see that in the fourth quarter of 2023, they've been able to increase their operating revenue by about 0.50%, which represents an increase up to $6.4 billion of quarterly revenue. This was mainly justified by higher product revenue of $1.1 billion, which was driven by a greater sales mix of higher value mobile phones and lower year-over-year device discounting during the Black Friday and December holidays sales periods. However, a pretty worrying point for the investors is that over the last 3 years, we can see that their total revenue have been slowly starting to decrease. A big part of it was linked to their Bell Media subsidiary, where we've seen that their advertising revenue have dropped by about $140 million in 2023 compared to 2022. It is why last week, during their earnings report, we've seen that they've announced a massive restructuration of the business where they will lay off about 9% of their total workforce. This actually represents their more important layoffs over the last 30 years, where it will represent about 4,800 jobs lost. In fact, these cuts will mainly impact big news media such as CTV and BNN Bloomberg, and the parent company has said that they were also selling 45 of its 103 regional radio stations. So in total, this will represent some cost saving of between $150 and $200 million. Unfortunately, the least we can say is that this type of company doesn't currently have a great momentum behind them, especially with this high interest rate environment that will highly impact companies like that are known to be high capital expenditures companies. Because in fact, over the last couple of years and decades, we've seen that Bell has spent a lot of its money to try to expand notably its 5G network all around the country. And so with this fast expansion, it also means that the company has contracted a lot of debt. However, at the end of 2023, we've seen that Bell has announced a total diminution of their capital expenditures of more than $1 billion for 2024 and 2025, where we know that their target diminution for 2024 is between $500 to $600 million. In fact, all of this money that they are cutting represents all the money that they plan to invest in bringing high-speed fiber internet to hundreds of thousands of additional homes and businesses in rural, subsaharan, and urban communities. These news came out after Canada Radio, Television, and Telecommunication has announced that they wanted to achieve more affordability for their different customers in terms of the different telecommunication services and products. It means that they want to increase the choice and the affordability of high-speed internet services for more than 5 million Canadian households, which obviously means that for companies like Bell, this will reduce importantly their total profit margin. The positive side about this type of news for Bell is that it should help them to reduce their total debt that has been growing quite importantly over the last couple of years, which has also made skyrocket their total interest payments during that period. Nevertheless, on a broader point of view, what is the most important factor and one of the best things for this type of company is the market in which they are evolving. Despite being in a sector that is starting to being more and more competitive, Bell still has one major advantage at the moment. It is one of the three largest companies that own about 30% of the total market right now. In this regard, and with the project immigration that should be coming in the country over the next couple of years and decades, it obviously is a clear no-brainer that this company could continue to grow quite importantly during that period. In fact, during the fourth quarter of 2023, we've seen that they have massively increased their total free cash flow despite some important decrease in their total net earnings. And this was actually linked to a slight increase of their total operating income linked to some increase in their important branches of their business model. These positive news have also been added with an excellent news that were coming for all the dividend investors, where we'll see a great 3.1% dividend increase for 2024. So with a dividend yield of close to 8%, it's going to be interesting to see what the valuation metrics are telling us about this type of company. The first thing that we can notice is that the company currently worth about $45 billion with a pretty fair price to earnings ratio of about 22, showing that the company is quite fairly valued at the moment. In terms of its profitability, we see that it has a pretty fair profit margin as well as a great return on equity of about 10% with an excellent operating margin of about 21% over the last 12 months. Plus, during that period, we can see that they've generated some revenue of about $24 billion with a super slow growth in their total quarterly revenue growth over the last quarter of about 0.50%, but with an important quarterly earnings growth decrease of about 25% year over year. But the biggest problem with Bell is by far the difference between the total cash, which represent only about $1.77 billion compared to its astronomical debt of about $36 billion. And in terms of its debt to equity ratio, we can see that this ratio is super high, which is pretty much at 176% right now. This is simply illustrating the fact that, in my opinion, this company has way too much debt, and it makes obviously that they are super dependent on the fluctuation of the interest rates. Now, when we take a look at the volatility of the company represented by the beta on a 5 years period, we can see that the company is normally less volatile than the overall market by about half of the total market. But over the last 52 weeks, we can see that it has been quite importantly down by close to 20% when the overall market has been up by about 23%. And so the other problem linked with their debt is that despite offering a massive dividend yield that is close to 8% at the moment, we can see that their payout ratio is way too high, with a payout ratio of over 169%, showing that they are using a lot of their debt to be able to pay the different dividends to their shareholders. Plus, as we can see during the last 4 years, we can see that their total revenue haven't been growing that fast compared to other big companies. And the problem with that is that we can also see that their total expenses have also been importantly increasing during that time, which has made that their earnings before interest and taxes haven't been really progressing during that same period. And add to this, we can see that in terms of their operating cash flow, they have even been diminishing during the last year, which isn't a great news for the different investors of BCE. And obviously, this has been reflected in their free cash flow progression, where over the last 2 years, we can see an important decrease in their total free cash flow. Now, to determine what is the true intrinsic value of BCE, we'll be using, as always, many different valuation models, starting with the Peter Lynch valuation model, which is a simple formula where you add the future growth of the EPS with the dividend yield and that you divide by the price to earnings ratio. And so with this model, we can see that the company would currently be pretty overvalued at the moment because of their low EPS growth that is projected for the next 5 years. Unfortunately, for the second model, which is the dividend discounted model, since we can see that our average growth rate is bigger than our WACC, it means that the model won't work. But for our third model, which is the discounted cash flow model, as always, we'll be discounting all the future free cash flow of the company to find its true intrinsic value, but we'll start by finding what is our discounted rate, so our weighted average cost of capital that we find by finding what is the cost of debt, the cost of equity, the cost of debt and equity, which is giving us our WACC. And so with these results, we can project what will be the future free cash flow of the company. And so we find that the true intrinsic value of it is about $66 per share, which is showing that the company at the moment with this model would currently be a buy with an upside of about 31%. And finally, with the fourth and last model, we'll be using the Graham's original value formula and the Graham's revised value formula. And with both of these models, we find that the true intrinsic value of the company is about $22 and $16 per share, which is quite massively overvalued right now. As you've been able to see in this video, despite offering a big juicy dividend, this company might not be as much undervalued as some might think according to the different valuation models. Personally, it isn't a company that is on my radar right now, but if it continues to dip because of all the bad news that they've had recently, well, I might be tempted to slightly increase the position that I currently have in this business. Nevertheless, as long as they won't be able to boost their total financial metrics, where we've notably seen that they haven't been able to grow their total revenue over the last couple of years, combined with some higher expenses linked obviously to the higher interest rates and with some super high payout ratio, well, I think that there might be better choices right now on the stock market. So on your side, if you're looking to find what are these options, well, check out the video that's gonna be right over here, and I will see you soon. Peace.